Hey, I'm Matt Jones, full-time real estate agent and full-time investor in Pensacola, Florida. I'm going to share with you some of the tools and tactics and strategies that I've used over the last 4 years to build a very strong real estate sales business, to build a nice portfolio of rental properties here in the Pensacola area, and to leave what was a very good career to get into real estate. So I look forward to having you with me on the journey as we talk about the ways that real estate can impact your life through the ways that it's impacted mine. So I look forward to sharing some of this information with you. All right, so I'm gonna do something that I'm asked about regularly, and that is how I run my numbers on a real estate deal. So anybody who also invests or is thinking about investing, they always want to know, hey, how do you run your numbers? How do you make sure that you're going to make money? What does a good deal look like? So I'm going to take you through a recent deal that I was involved in. I won't say that they all have numbers this good, but I just want to use it to kind of illustrate a point of not only what the numbers look like, so a deep dive into the numbers, but also the different ways that real estate, makes you wealthy over time. So let's look at the numbers. Start out with, it was a quadplex. Purchase price was $210,000. Down payment of 20% on this particular property. Yes, 20% down payment loans are out there if you know what you're doing and you have a track record. So $42,000 down payment. Right off the bat, it was going to need $7,000 worth of work. Total cash invested, $49,000. Monthly gross rents were $3,000. I think probably a year or two down the road, once the place is stabilized and a few more small renovations have done, those should shoot up to $3,500. But today, $3,000. Mortgage is $168,000 at 5% for 20 years, comes out to $1,108. And monthly tax escrow $266, insurance $250. That leaves you with $1,376. Now, if you are an investor, you already know this. If you want to be an investor, pay attention to this part. You do not get to keep all $1,376 of that. The first thing that you need to think about that's going to come out of there is management. So I use 10%, that's $300. You might get it for more, you might get it for less, depending on who your manager is, what their experience level and service level is, how many units you have. You might get a discount for having a lot of units. You might pay a little bit more if you just got one. But 10% is kind of a good average number. I put in 10% for capital expenditures. That basically is going to go into a savings account, $300 every month, and that way the next time an air conditioner breaks or if the property needs a roof, we're going to have 10% to go right there. So that's $300. Figure 5% for vacancy. In Pensacola, my experienced vacancy has actually been lower than 5%, but I leave it in there to cover some credit losses, just in case people don't pay. If you do a good job screening your tenants, hopefully that won't be an issue. But what that brings us over to is a cash flow of $626 a month, $7,512 per year. So based on total cash invested, 7512 divided by the total cash invested, 15.3% cash on cash return. Yes, some people are going to say, hey, what about repairs? Typically, when I buy a property, I renovate it, so there's going to be minimal repairs due the first several years, and my capital expenditures are also going to be low, so I grouped them all in here. If you really weren't sure about the quality of your property, or you just want it to be super conservative, you could put another $300 in to cover repairs. For this, I'm not going to. My experience repairs on the quality property that I have just come out lower than that, to the point where I'm comfortable grouping it in with CapEx. So 15.3% cash on cash return. We're talking about a physical building, something that people are always going to need a place to live. Even if rents come down a little bit, the economy crashes, they're going to need a place to live. So you've got 15.3% cash on cash return in something that's tangible. If you got 15% on something intangible like the stock market, that would be a great return. But on something tangible, it's just kind of unheard of. Now, that's not where the story ends. So this is one of my favorite things about real estate, is over time it's going to build your wealth in some other ways. One of those is it's going to appreciate over time, presumably. Real estate has a steady history of increasing in value, which is fantastic. I don't count that personally. I have no idea what it's going to appreciate at. Now, yes, I could tell you what the forecasts are. I can tell you what's historic for the area, historic for the nation, but as an investor, I don't care about any of that. I know that specifically multifamily investment property may not appreciate the same way that everything else does, and I just don't count it. But what I do count, because it's there, is the monthly principal pay down. So every month when I pay that $1,108 for the mortgage, a portion of that is going to go toward paying the building off in 20 years. Every month a little bit more of that will go toward paying the building off. So every month you're making a little bit more toward your principal. But the first year is when you make the very least, so that's the number I used. In the first year, it's going to pay off right at $5,000 in principal of the $168,000 loan. So if you add $5,000 to the $7,500 it's already going to kick off in cash flow, you're looking at a 25.5% total return. Again, it's real estate, so that's really not the end of the story. The other really nice thing that you're going to get is you're going to get depreciation. Talk to your CPA, get their information, but for this one, the tax appraisal for the improvements, which is the building, not including the land, was $176,000. So when you do what the IRS allows, which is, again, talk to your CPA, but you take that appraised or that appraised improved value, you divide it by 27.5, you can count that as depreciation on the building. So at a 25% tax bracket, that comes out to another $1,600. Of course, rents are going to go up over time, and there's just so many ways to make money in real estate that you can take something that looks like an average deal, and if you hold it long enough, it's going to be a fantastic deal. And you can take a fantastic deal, and it's a fantastic deal from day one, and eventually it's just a cash cow. Something like this paid off 20 years from now when the building is paid for and all you have to do is repair it and pay your taxes and insurance. This could be somebody's retirement. This may put off as much cash as the Social Security payment you get after working for 40 years. So people, everybody wants to be in real estate, and I think some people kind of think, oh, that's silly, or they're going to get burned, they don't know what they're doing. But there's a reason everybody wants to be in real estate, and if you do your homework and you work with professionals, I think you can absolutely make phenomenal returns, and it's still the best way to get wealthy in America. I hope this has been helpful. Let me know what questions you have. If you run your numbers a different way, you want to critique my numbers, absolutely do it. I'd love some feedback, so I hope to hear from you. Thanks.